Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as stockcharts.com. So we've had quite a rally, and we pulled back here yesterday. I think it was from Tuesday to Wednesday. That move alone had more range between the 2 days than the entire month of January. So we're having massive moves here on 60-minute time frames that are really, if you said to somebody, do you look at 60-minute charts? Well, now you have to, because they're literally moving weekly and monthly levels in a few hours. So the craziness of the market is driving us into shorter time frames, and the moves are very exaggerated on that level. So what I'm going to cover off today, in general, the market is trying to halt the downside momentum. That doesn't necessarily mean it's trying to go up. It's just trying to get the selling to stop. And the Fed has done a remarkable job of buying treasuries between March 17th and April 2nd or something, like a very brief time frame. 2 weeks, they've spent over $1.3 trillion. I don't know how you could even read what you were buying in that time. Um, and there's, I think it was 400 billion of corporate debt or something. So you'd have to read all through that. And then you got another 900 billion of treasuries. Like, the numbers are just so hard to fathom, spending all that in 2 weeks. Anyway, so the market is in a very odd spot. And I think at this point, I find no value in somebody telling me what stocks are starting to go up here. And maybe this is the low, but I just, to me, sitting here and watching all of the news come out so negative and expecting your stocks to go a whole bunch higher just doesn't seem like I'm ready to do that yet. When the main indexes turn enough for me that I start to get buy signals on the indexes, other than a short-term trade, then I'll be more interested in picking some names, but at this point, not really. So what I wanted to do today, I get a question roughly once a month about asking me why I use the indicators I use. And so what I thought I would do today is work through the indicators that I have, and the idea being behind that I would share with you my thoughts on how I picked them, and then work through that. So if you can bear with me, this is what we're going to cover off. So on this particular chart, this is a chart of gold. It's from 2016 to 2019. It wasn't all about getting set up now for the rally tomorrow or whatever. It was big picture, take the urgency out of the situation and discuss the indicators as they're presented. And so the one thing I wanted to do was work through line by line. And up at the top, what we see is a purple shaded area. And on my charts, on every one of them, when I have a purple shaded area, that means that it's the relative strength compared to the S&P 500. And what we see for a long period of time here, there's this downtrending green line. And gold was underperforming the S&P 500 for literally 3 years, and at the end of the year just started to turn up slightly. The benefit of being aware of what the trend is outside the individual stock, so not just looking at itself, but how it's doing compared to everything else out there, is that new investors want to buy stuff that's outperforming or is going to start to outperform, and that has to do one of two things. Either it has to already be trending it up, or it has to break out of an existing downtrend in order to start trying to outperform. So to me, when you pick an indicator, one of the indicators you need, or I think you need, is an indicator that compares to something outside. So either the SCTR ranking, the StockCharts technical ranking system, it's like a sports ranking for stocks. I think that one's very valuable. I think this relative strength compared to the S&P 500 is valuable. And one of the things about comparing it to the S&P 500, so I'm Canadian, I could compare it to the Canadian stock market as an example, the Canadian index called the TSX. But the TSX has 2/3 of the stock market weighting in oil and gas, materials, and banking, and 1/3 in industrials and healthcare and IT and all that kind of stuff. So we don't have the same breadth that the U.S. market has, and when we try to outperform the S&P 500, if oil's on a big surge, the odds are, and we underperform that, we haven't necessarily outperformed some sort of big major average. We've just underperformed oil or outperformed like one of the smaller industry groups, one of the smaller sectors. So it's more important to find something like the boat anchor that is the S&P 500 that is just so rigid. It's like an aircraft carrier. One sector isn't going to blow it offside. And so when you actually have something outperforming the S&P 500, um, that's a big enough comparative tool that most institutional investors are also trying to outperform either their sector or the S&P 500. And in this particular case, I find that when things start to outperform the S&P 500, it's usually a pretty good place to get on board when they start to outperform. And so here we've broken this big downtrend in relative strength and started to turn up. The second indicator I have is a full stochastic. And what the full stochastic tries to compare is where is price relative to the most recent period of time. And in this case, I've got a 14 period um, look back period. So that's roughly 3 months, and 13 weeks would be 3 months. And so you look back 3 months and say, how is price doing compared to back 3 months? And then it smooths it with this 3 period moving average. So you end up having this range, right, where the stock is clearly at this point, it's outperforming everything. And so it soars up, but because it's a moving average of the last 3 weeks, it's going to, even though it's up at the top here, it's the moving average of these three. So it's never going to say 99. It's going to be up very close, or very rarely would it say 99. So price runs up, and then as it rolls over, it gets a little weaker. Well, here it breaks down, and by this point, it had been trending toward the bottom half of the last 14 weeks, and then all of a sudden it breaks down hard. So it's down, and it's saying, it's weaker, and it keeps going down, and then it sits down here all through this downtrend. So because it's a bounded oscillator, in other words, it goes from 0 to 100%, it it doesn't go any lower. It just stays down at the bottom and stays there. And then when things start to improve, it turns back up. On a weekly chart, one of the earliest things to turn is the stochastic. And so I like to just use it for that purpose to help me get in, and also just to help mentally see when the momentum is waning. And the other two important points of this indicator are when it stays above 50, you're in a big bull market trend. When it stays below 50, you're not. And just understanding that very, very clearly, if it doesn't hold at 50 and starts to fall below, that's showing weakness, and it can take another 3-4 weeks before it actually turns up. So just using that to help tell me where price is relative to history, I can scan for that. I can say, I want to find things that were below the 20 and starting to turn up, or things that were above 80 and starting to turn down. And it's going to give me this one, and this one, and this one, and this one. And so you still have to do your homework. It's one scan that you could run to help find where stocks are starting to improve. And that's really hard. Like, I can't program in all of the price turns. Well, I could try. One of the easy ways to do that is to use the full stochastic and look for turning points on that. So then the next thing that I've got is the actual price. And in this case, I'm using open, high, low, close bars. And the reason I do that is when I use a candlestick chart, always the negative candles are big and bold, right? They're either red or black, and they're solidly filled in, so they kind of stare at you, and they're more ominous, and they have more uh, they catch my attention more. So I find I'm more negative when I look at a candlestick chart. You might laugh at that, but I prefer something that I'm looking at the price trend, and obviously I can see it's going down. I don't really need this big bold red bar telling me it's horrible. I just need to understand the momentum of the chart, and I don't really want the mood swings associated with, I'll call it that blunt graphic illustration. So trying to use that as a different method of projecting it. So again, the tab on the left here is when where it opened. The tab on the right is where it closed. The length of the bar is the low is the low of the week. The high is the high of the week, and then the two open and closing points. And you, with that information, that's more than enough for me on the chart. The next two things I have on here are moving averages, and a moving average, in this case, this green line is a 40-week moving average. It drops the 41st week when you look back, so it'll drop whatever 40 weeks ago was, roughly 5 quarters. Is that right? No, 3 quarters. So it looks back 3 quarters of a year. So from here, you're looking back towards the beginning of the year. And when that old one falls off and the new one is added on, it's you're improving. So all of a sudden, it's going to make the line rise, and then conversely, when you're adding new ones down low and dropping ones up high, your moving average starts to roll over and starts to fall down. So a 40-week moving average is considered a longer moving average, so it runs relatively smooth through here. And then the 10-week moving average is in blue, and it's much more, it follows the price a little closer. And it also, on the way up, for the most part, it's support. On the way down, it's resistance. And then through here, you don't really have a trend. You have two flat moving averages. You have flat price, nothing really going on. What's an easier trend to buy is something that is trending up. Moving averages are properly sorted, where the 10-week is above the 40-week. Both lines are making higher highs and higher lows. Price is moving up. And then you get over here, and price is starting to move down. Moving averages are moved down. The 10-week is now below the 40-week, suggesting more significant weakness. And it takes almost 4 months for this to kind of bottom out before it gets improved. So the moving averages, just, are they trending up? Are they trending down? You can sort for that. Is the moving average higher than it was a month ago? You can also look for price that's above both its 10-week and 40-week. So you can use them as measurement sticks in your scans to try and find stocks that are starting to work. All of that, in this particular case, this price action, for the most part, 3 years of sideways price action, no real money to be made. But the one thing I would also say is you want a scale that's actually moving a lot. And the reason is because even if you're only in it for 6 months or something, you want the stock to have enough momentum to actually make you some money. Whereas if you're in some sort of I'll just say a bond ETF, and this week isn't probably a great week to use that because they've moved so much. But historically, in relatively calm water, a bond ETF, is moving 10 cents, 15 cents. It's not enough to really have the risk in being invested and not getting a capital gain, because you still have the risk of loss. And so the point would be, try and make sure your scale has enough room for the stock to actually move a significant amount of money in a relatively short period of time, 3 months, 6 months, a year. And if it keeps going like a Microsoft or whatever, great. But if not, you want to be able to take out a 25% swing and move along and pick your next stock. Okay, I've also drawn two trend lines on here. This line is just sitting at what I would call support, and I could put it lower, but I've put this on here just to kind of give me, that's where the majority of the line stopped all the way across here. There's been two places, this dip and this dip over here, that line let go a little bit, but not too bad. I think that's a pretty good support line. So anyway, the idea behind annotating that is just to say, this is 1200 is pretty good support, and up at the top here, a limit would be 1375. And then we had a downtrend line, and we use that to decide when price is breaking above it. So all of these are just different tools, but this is an external where I'm comparing to something outside. And then this full stochastic, I'm comparing to where it was for the last 13 or 14 weeks. And then we can use the moving averages to say, are they trending up? Is the price trending up? Are they in the right sort order? So is the 10-week above the 40-week currently? Have we where are we on the relative chart? We get that from the full stochastics. Are we at the high end of the range by being below 20? Sorry, at the low end of the range below 20 and the high end of the range above 80. So we can use a couple of different things in our scan to try and find stocks that might have the setup that we're looking for. So again, external, internal, um, specific data about the price action, and then, whoops, and then in the week following that, we have, or sorry, in the panel following that, we have the volume. And one of the things about the volume, I actually find volume is very much more an art than a science. As an example, you can have a high volume selling week and a high volume buying week, and the high volume buying week a lot of times might mark the actual top in the stock, and the high volume selling may or may not mark the low. In this case, it didn't. This one over here stands up quite a bit. It's kind of a 3-month high, and that actually marked the low. And you have, so volume, you're looking for exceptional volume, like extra high or extra low. You have to be, let's just say a 3-month high or a 3-month low in volume is kind of unique, or a 1-year high or 1-year low. That's an important characteristic. Then another characteristic you have to worry about is low volume around Christmas and around Thanksgiving. You might also have low volume on a shortened work week where there's only 4 days trading instead of 5. So that's going to push down some of the bars. But if you have a normal week and you're making new lows in the stock market, so here's one in early October, you're making a new 1-year low in volume, and you're wondering like what's going on, and the stock is trying to rally after a big pullback. And so is it no sellers or nobody's interested? One of the two is true. And anyway, so volume, you want to look for those kind of exceptions and then just try to understand. As an example, in this particular case, the last 3 months, even though it's been rising, the volume has been less than average. So is that good? Well, it could be you're just having trouble finding a lack of buyers, or it could be nobody wants to sell it, and this is kind of going to be the new trend for the uptrend. Um, I find volume harder work for me, but I still want to know what is the volume doing, and when I start to see exceptional volume, there can be some clues there. Okay, the next thing I want to talk about is the PPO. And the PPO for me is a pretty important indicator. It's one of my primary things that I look for, scan for. The type of information I'm looking for is it above zero or below zero? And normally, and we'll talk about this with some real stocks here right after this, when it's above zero, what you want to see, that's a strong stock. And when the PPO goes below zero, especially on weekly charts, usually the faster downside moves happen when the PPO is below zero. So in this particular case, roughly in early November, this was the big downside move, but it traveled down for another 2 months. And while your full stochastic stays flat because it's bounded between 0 and 100, your PPO is not bounded. It can go down very deep. There's no sort of outside range for it. So this gives you an idea. And when it finally hits bottom and starts to turn up, that's a pretty nice clue. So I like to see that. Then the other thing is when it is declining and below zero, Martin Pring had a term for it. No, I'm going to cover them off here. But when you're rising from below zero and still below zero, you're in the spring position. When you're rising and above zero, you're in the summer position. When you're in the fall period, you're above zero, but you're sliding back. And when you're in the winter position, you're below zero and pushing down. Those simple characteristics just say on a weekly chart, if you're in something that's going below zero, that's probably a great place to be cautious. Now, some people would say, great, it's finally getting into my buy signal. But I'll show you some examples like ExxonMobil just doesn't do much, hasn't done much for years, and it's lived on the lower side of zero or up to zero, doesn't really do much. A Microsoft stock, on the other hand, has spent years with the PPO sitting above zero. Amazon, same sort of thing. And so the stock in general has more momentum. That's what the PPO measures, is momentum. The second thing about, or the next thing about the PPO that I like to think about is the overall trend. And I'll show this to you, comparing it to the MACD in a little bit. But what you see on the PPO is that when each high is a lower high, so here you have a high, here you have a high, it's a little lower, here's another lower high, another lower high, and now you're bouncing up here and we don't know if this is going to roll over. Well, if it's going to roll over below zero, that's one of the most bearish places you'll find. Usually when something gets up to zero and then rolls over again, it accelerates lower. So I like to be very aware of how the price action behaves near zero. So all of these bounces, so this was a bounce near zero, that's bullish, bounce near zero, that's bullish. Here it didn't bounce, it just kept going straight down. And now we're coming up to the zero level and we want to know if it can make it through. Now this is unique because it's also, not only is it trying to get through the zero line, it's also trying to break this 3-year downtrend in momentum. And if that was going to happen, then that, in my opinion, that's one of the more important things. You actually have a change in trend in momentum over a long period of time. So perhaps you could be setting up a major low and starting to break out to a new long-term uptrend. And I have a few stocks that will go through here right away. So in general, this is my momentum trend. This is really big picture, and I can compare this back 3 years or 10 years or 20 years. I can't do that on the MACD unless the price travels in a similar area, because the MACD will actually make a higher wave with a higher price on the stock and a lower wave when the price is lower. So if we look at Amazon, there was a period of time, it was back in the $5 level back in the early 2000s, $5 or $15, something like that, and now it's up around 1750 or 1800. The MACD will make much bigger waves up here at 1800, but the PPO may or may not. And the reason is it's using a percentage instead of the actual dollar amount of change. So a $5 move back in the early 2000s would have been a double for Amazon. A $5 move now for Amazon is just, minute by minute trading. So the percentage is nowhere near the same, and that's what the PPO would show the difference, whereas the MACD would say it's the same as it was way back in 2002. So that's why I use the PPO, not the MACD. And it's the intricacies of the PPO that I really like. I focus a lot of my scans and a lot of my work around that. But when I have a downtrend of 6 months and it's starting to break, that's a very bullish signal to me and something that I'm very interested in. So as an example, in the fourth quarter of 2018, we had a big market pullback, and just what was happening in gold is gold was actually pulling back before that, and then as the stock market started to break down, which was literally the end of September to the end of December, gold did exactly the opposite. So gold actually went up while the stock market went down. And that may or may not be normal. It doesn't happen every time, but it's one of the things you could watch for. So in this case, you have downward momentum that's been going on for 6 months. It finally breaks and starts to turn up, and you go up and look at the price action on the gold chart, and it did pretty well at breaking out then and starting to move up. I would say it broke a very short little trend in price here, but the bigger trend in price was going back from April all the way through to December, and that's when the price finally broke. But momentum had changed before that, and look at the volume surge coming off the low that we got, and then price ran up for a couple of weeks, pulled back for a couple of weeks, and then took off to the upside. So it's one of the things that we need to focus on when we're using these tools is how do they behave, and over time, by keeping the same tools, you're going to learn which ones you like. So again, external, internal, where is it in terms of the last quarter? Where is it in terms of the moving averages? Is the volume improving or weakening? And again, we're looking for exceptional volume. So in this particular case, year end again, end of December, so lots of vacation, not that many traders. Price will typically make a low around the end of December. But what you want to watch for is other periods where it's either an extreme high or an extreme low. And then the PPO is the actual longer term momentum. Am I breaking out of some sort of a multi 6 month trend? And there's no real way to scan for that. There are ways to scan for that are complex, but you end up making the scan so complex you miss a lot of good trades. What I find is I'm better off to look for something that's giving me a PPO that's turning up after being down. So I could scan for something, a PPO that is better than it was 2 months ago, better than it was, or lower than it was 2 months ago, lower than it was 4 months ago, but is now starting to give me a cross. That gives me an idea that I might actually have some sort of a longer term trend that's breaking. And then I really like it when the big trend, like a 2 or 3 year trend, is breaking, and there can be some big opportunities. Okay, I'm briefly going to jump over and look at a typical chart here. So here's Thomson Reuters in a big downtrend here for 4, 5, 6 months, and all of a sudden it starts to break out. And as it breaks out, the momentum is really starting to improve. Your full stochastic is turning up. Your scooter ranking, I didn't talk that much about that, is starting to improve a little later on. It's kind of after some of these other clues have started to kick in. It's like a month or two later. But price was trending down, 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 starts to turn up. You're breaking longer term trends, and it starts to break out. You're going above zero. A really nice run, and this whole run here is almost a double in a little over a year. So it's that kind of thing that you could get a trend change from. And again, it starts to outperform its peers. It starts to outperform the S&P 500. On the full stochastic, it stays above 80 for a nice long period of time. And on this particular case, now it's making a lower high in momentum and a higher high in price, so that's a negative divergence. So we want to see that change. I'm going to quickly whip over and show you Amazon. And what I want to show on this particular chart is a longer picture of 25 years. And I want to go grab a MACD and just put it on the bottom here. And the point I want to make about the MACD, where is it? Is that the MACD will have bigger waves on the right because the price is bigger, whereas the PPO said that there were actually bigger percentage gains way back here. There was 15% gains back in the early 2000s, and that's almost muted by the MACD, whereas here it looks like it's been the best rally ever, and in Amazon history based on the PPO in terms of percentage gain, it's pretty typical. But I would say on the PPO, Amazon for the most part stays above zero all the time. If I change this to whatever we're going to pick, ExxonMobil, and we have exactly the opposite where it doesn't stay up very well at all. It makes a lot of dips below zero, and for the last 3 or 4 years it spent very little time above zero, and so the stock really doesn't have a lot of positive momentum. You can have different names. I'm going to use Shopify just because I know it's been one of those stocks that broke out nicely, and we're just going to change it back to 5 years. But the benefit of finding these sorts of triggers, you can see a nice big downtrend here for 2 years. The stock turns at the end of 2018 and goes on a big run from $164 to $409 in almost a straight line. Beautiful run that you can find. So you're looking for these long-term trends that are breaking, and when they do, they can be very helpful. So those are the tools that I like to use. You don't have to use them, but try and find a group of tools that one's inside, one's outside, one's helping you with short-term momentum, one's helping you with, multi-year momentum. And hopefully from that, using a variety of indicators, you'll start to find better trade setups and hopefully take a little bit more home. So thank you for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays and Fridays at 10:30 a.m. Eastern. You can also see the recording on StockCharts TV YouTube page. And if you get a chance, head over to gregschnell.ca. I've got a new website up there and just starting to get that working. Thanks, everybody. Have a good week. Bye-bye.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.